Charles Korchinski, you launched the Rothschild Larch Lane Alternatives Fund last summer. You've been beating the S&P ever since. You're up 8% year to date. What's in it? How are you doing it?
Well, really it's a combination of a variety of asset classes, different time frames that the managers trade upon, and really different investment styles that are utilized by the underlying sub-advisors that are in our product. So ultimately what we've had is a pretty broad opportunity set in the portfolios, the way we designed it from day one, and we've been fortunate enough to take advantage of some of the opportunities that have come up in the marketplace.
Which strategies are working best for you right now?
You know, I think a combination. We've been fortunate that all the strategies since inception of the fund and this year have been profitable. But when we look underneath the hood and we decipher where we've had the most profit, it's really been driven by a variety of global bond trades as global inflation and global growth has been tempered a little bit. We've had profitable trades in the US dollar where we've been long the dollar and short foreign currencies. We've also had profitable trades in short energy space. More recently, some of our managers have been bullish in European equities as well as Japanese equities, so that's been a positive one.
And you use early stage fund managers, hedge fund managers that is, even though you're in a mutual fund, and established ones. Who does better, the young hungry guys or the established ones?
You know, I think there's a lot of research that's been generated over the years and studies that have been done that have shown that early stage managers do tend to outperform their larger counterparts. We like to have a mix of both in all of our products as well as the mutual fund. So, you know, I think it really is dependent on where you're looking.
And you charge 2.5% as an expense ratio for your fund versus hedge funds which charge 2 and 20. So it seems like, hey, that's a bargain, right?
It could potentially be. I think that if we're able to deliver what we seek to, it's definitely cheaper.
The reason why I say that is because we saw a lot of hedge funds close last year. Some people say it's poor performance. Other people say it's because of the rise of liquid alternatives and the fact that mutual fund investors can now get hedge funds, but without giving up the profits. What do you think?
I think that, you know, I think it's probably a little bit of both. I think that investors sometimes will benchmark their hedge fund investments to the stock market. The stock market's been a great place to invest over the last 5 years or so. So I think part of it is some of the fatigue related to that. You know, one of the best bets you could have made was long S&P. But I think that as time goes on, and as investors, especially in the retail space, have a need for something that zigs maybe when the market zags, or the potential to profit in less good equity markets, you know, we'll continue to see a rise in the attractiveness of these products.
Thanks a lot, Charles.
Thanks, Greg.
And thank you for watching The Street.